Ever wondered how to pick the right stock? The secret lies in a process known as fundamental analysis. It's a strategy used by experts around the globe to evaluate a business's intrinsic value. But what does it entail? How does one go about it? Stay tuned as we unravel this mystery in the next 7.5 minutes. Now, imagine that the stock market is a bustling marketplace. Amidst all the noise and chaos, fundamental analysis serves as your compass, guiding you toward the right choices. It's your map to the treasure trove of profitable investments. The first step in this journey is an examination of a company's financial statements. These documents are the company's report card. They reveal the company's earnings, expenses, assets, and liabilities. Essentially, they give you an insight into the company's financial health. Next, dive into the income statement. It's like a window into a company's profitability. It shows you the revenue a company generates, the costs it incurs, and finally, its net income. A company with a consistent record of increasing net income might be a promising investment. Now turn attention to the balance sheet. This document is like a photograph taken at the end of the fiscal year. It gives a snapshot of a company's assets, liabilities, and shareholder equity. A strong balance sheet usually has more assets than liabilities, and a growing equity section indicates a company that reinvests in itself. Then, there's the cash flow statement, a crucial tool in understanding a company's financial health. Imagine it as the company's financial diary, faithfully documenting every cash inflow and outflow during a specified time frame. The cash flow statement is divided into 3 main sections: activities, investing activities, and financing activities. Operating activities encompass the cash generated from the company's core business operations. For instance, if a retail clothing chain sells a pair of jeans, the cash received from that sale would fall under operating activities. Investing activities, on the other hand, cash transactions related to investments, such as purchasing or selling physical assets. For example, if our clothing chain decides to buy another store, the cash spent on the purchase would be part of investing activities. Lastly, financing activities involve the inflow and outflow of cash from investors and lenders, such as issuing stocks or paying dividends. If the company decided to issue more shares to raise money, the cash received from the sale of those shares will be recorded under financing activities. A positive cash flow indicates has enough cash on hand to cover its operations and obligations, a sign of financial stability. Consider Apple, for example, known for its consistently strong positive cash flow, which allows for continuous innovation and market expansion. On the contrary, a negative cash flow signifies more cash is going out than coming in, highlighting potential financial distress. General Electric experienced this in 2017, where their negative cash flow resulted in decreased dividends and significant operational restructuring. So, understanding a company's cash flow statement is not just about knowing how much money a company has. It's about understanding where that money is coming from and going to, and the implications of these transactions on a company's financial stability and growth potential. Let's take a closer look at cash flow analysis. One crucial concept is free cash flow, which is the cash a company has left over after it's paid for its operating expenses and capital expenditures. It's the money the company can use for expansion, dividends, debt repayment, or other business activities. Calculating free cash flow is straightforward. Take the cash from operating activities and subtract capital expenditures, which you can find on the cash flow statement. Free cash flow is often used in valuation models, as it provides a clear picture of a company's financial health and the cash it can generate. It's a more precise measure than just earnings, as it considers the company's cash inflows and outflows. Consider Microsoft, for instance, known for its strong free cash flow. This allows the company to invest in new technologies, pay dividends, and repurchase shares, contributing to its ongoing success and market dominance. Understanding cash flow, particularly free cash flow, is crucial in fundamental analysis. It provides a clear picture of a company's financial health, its ability to generate cash, and its potential for growth and success. But fundamental analysis isn't just about number crunching. It also involves understanding the company's business model, its competitive positioning, and the industry in which it operates. This requires a deep dive into the company's annual report and other public documents. After gathering all this information, compare it with that of other companies in the same industry. This comparative analysis can give you a sense of which companies are outperforming their peers and which are falling behind. Scene script, voiceover. Now that we've analyzed the company's financials and compared them to its peers, it's time to delve deeper into the concept of intrinsic value. This is the estimated true worth of a company, regardless of its market price, based on its fundamental analysis. Intrinsic value is vital as it gives us a benchmark to compare with the current market price and decide whether a company is undervalued or overvalued. There are several ways to calculate it, such as the discounted cash flow analysis, similar to what we'll discuss in the next scene, or earnings multiples, among others. However, it's important to remember that these calculations are not foolproof. They rely on assumptions and estimates, which means there's always a degree of uncertainty. Let's take an example of companies like Amazon and Apple. Their high intrinsic value, derived from their strong fundamentals and growth prospects, have contributed to their success and investor confidence. Understanding intrinsic value is crucial in fundamental analysis, as it helps investors make informed decisions. It's a tool, not a crystal ball, but it can certainly guide us towards more informed investment choices. In conclusion, the crux of our discussion rests on the intrinsic value of a company, a range rather than a fixed figure that offers a benchmark against which the current market price can be compared. It's all about the art and science of making well-informed investment decisions. By understanding the intrinsic value, you can better navigate investing and potentially make more lucrative choices. It's also crucial to emphasize the role of fundamental analysis in the stock picking process. This is where the financial statements come into play. They provide a clear snapshot of a company's financial health, including information about its assets, liabilities, earnings, and dividends. This data, combined with the understanding of the company's business model, helps us to gauge its overall performance and future prospects. Comparative analysis, another important aspect, allows us to evaluate the company's standing within the broader market context. It's about comparing the company's metrics with those of its competitors or industry averages. For instance, if our company's price-to-earnings ratio is significantly lower than the industry average, it may point to undervaluation. Successful investors like Warren Buffett and Peter Lynch have long championed the use of fundamental analysis. They've made fortunes by investing in companies with solid fundamentals and whose intrinsic value outweighed their market value, demonstrating that this approach can indeed be highly effective. And let's not forget the discounted cash flow analysis, or DCF. This astute method takes into account the money an investment can generate in the future and discounts it back to its present value. It's a balance of optimism about the future and a reality check about the present. So, as we wrap up, here are the key takeaways. Understand the company's business model, delve into financial statements, perform comparative analysis, and calculate the intrinsic value. The financial world may seem like a labyrinth at times, but with these tools, you can transform it into a puzzle that's not only solvable but also immensely rewarding. Therefore, I encourage you to take this journey of continuous learning and application. Embrace fundamental analysis and use it as your compass in the often choppy seas of investment decisions. It could make all the difference between charting a successful investment course or getting lost in financial turmoil. So, to recap, picking the right stock involves a careful examination of a company's financial statements, understanding its business model and competitive positioning, comparing it with its peers, and calculating its intrinsic value. Remember, like any good treasure hunt, the journey of fundamental analysis is filled with challenges, but with patience, diligence, and a keen eye for detail, you can navigate the choppy waters of the stock market and unearth the hidden gems. So, equip yourself with the tools of fundamental analysis and set sail on your own investment journey. Thank you for joining us today as we explored the world of fundamental analysis. Stay curious, stay informed, and most importantly, stay invested.